We were founded in 1888.
Really? I think what you're trying to say is between efficiency and commercial margin approach to market risk versus, completely conservative and, commercially killing, right? Is that kind of what your question is? It's more of an art than a science. I think there's somewhat going to be there's core principles that are going to be evinced in the rules that are going to constrain us a bit, right? And I think if we've got sort of reckless, it'd be fairly obvious, and people would, our clearing brokers, ultimately it's their capital that's at risk in our clearinghouse, so there's a lot of controls around that. There's a risk committee that approves our margin methodologies. It's made up of all our clearing brokers, has an independent buy-side member as well, members of our board, and our company is at risk as well, dependent on our risk management policies. So there's all these sort of controls behind these, and these just kind of two visible levers of the guarantee fund and the margin requirement that go into ensuring that we do our due diligence and we don't compete recklessly on margins.
Yeah, I mean, I think as Mark points out, we've been in the business for a while of clearing these and in our company various other instruments, and it's not clear whether the regulators will just tell us all to do it exactly the same way, or whether they'll give us some leeway to do it. If they give us some leeway to do it differently within parameters, then the balance, as Mark said, between the margin and the default fund could be a little different, and for every firm, that could have different implications for you. So it's worth understanding that, both in sort of estimating the riskiness of the clearinghouse and what it means for your kind of priorities in your portfolio. Like generally speaking, our risk philosophy has been to have very much what we call a defaulter pays philosophy, which means that we put probably more weight on the margin piece, so that the person who introduced the risk into the system is the one who ends up kind of eating the loss if there is a default, and that's not mutualized if the defaulter has the ability to pay for that. I think there are also implications for if there's sufficient margin on hand, that means there's a greater likelihood that if you're a client and your clearing member goes under that and you want to move your position across to somebody else, there's a greater chance that that there will be enough collateral to support your position. There will be another clearing member who's actually willing to accept that position transfer rather than waiting X period of time till the dust settles. But these are getting, I think, fairly kind of technical or examples for this audience, and I think this is the kind of thing that certainly at LCH SwapClear we'd be happy to talk to people about. I'm sure Mark and Corry and their colleagues would be happy to do the same. It's part of the education process. We very much encourage the people who are moving into clearing to do.
Great. Another question?
Got a question for Bill and for Nathan. Can you estimate the degree of complexity for your organizations to become CEFs and in effect turn the engine over on a scale of 1 to 10? Have you looked at it, and how difficult is it for your respective organizations to do that?
Sure.
Let me. Do you want to start? Okay. It's actually something that it's not something that we're becoming a CEF isn't really the hard part. We kind of view ourselves as a CEF. We've met all the criteria of what the proposed rules define a CEF as. In certain aspects, we've been a CEF since we turned on the lights, back in '98, and then started trading derivatives in 2005. So I think a lot of that, the heavy lifting has already taken place. What we've done over the last, almost 2 years, since even before the Dodd-Frank bill was passed, is focused more on kind of the administration of how it's all going to work. Sure, there have been additional technology investments, and but that's what we do. Whether it was Dodd-Frank or CFTC, SEC regulations, or some other thing, we'd be making technology investments. We're now kind of moving into more of the administration of the business. We've recently brought in some chief compliance officers to focus on what will be our CEF, technical. This is our CEF solution. He's going to be the head of the business. We're moving resources. There's a big HR component of it, to putting the right people in the right places. It's a lot of work, without a doubt, but it's work that we'd probably be doing anyway if it was under a different kind of directive.
I guess, Bill, to qualify that question a little better, is what have you estimated technological changes you may have to do to provide that capability?
Sure.
And how much will it cost? That's what I wanted.
No, I don't know. I don't see the P&L, quite frankly. No, but to answer your question, I don't know exactly the numbers of how much it's cost. I can assure you that those investments have already been made based on the original proposals of what we would be offering. We've made enhancements to the trading platform now, so it reflects a lot of the things that are required by the CFTC and SEC proposals. And then there's other investments we've made. Tradeweb is also an owner of a interdealer broker, DealerWeb. So there's some technology that's on that side that we can leverage when the final rules come out for things like the kind of order matching and all of that. So in terms of dollars and cents, I wouldn't have an answer for you, but a lot of that investment has already been made and is being continued to be made.
I was more interested in the complexity as opposed to the dollars.
Okay.
I think I think Bill makes some good points. So I think it's different for a Tradeweb and a Bloomberg who've been in this space for a while. I mean, we already have probably about 25 to 30 liquidity providers. We have 600 clients already trading. We have roughly, at the moment, close to sort of 1,000 trades a day in derivatives that go through the systems. We already have all the live links to clearing for each of the clearing houses. So we're already doing it, but we're both advantaged because we've been doing it for a while. I think some of the newer entrants will have obviously a huge technology build. I think specifically from now till January or whenever the implementation periods become finalized, I think there'll be some tweaks we'll have to do. There'll probably be some slight tweaks in the price discovery that perhaps are mandated. We'll have to do a little bit of work around if this is a required transaction, i.e. one that must be cleared, we'll channel it this way. If it's above a block size or a slightly bespoke transaction, then we'll channel it another way. We'll have a little bit of work to do around that, but nothing sort of beyond our daily, what we sort of do every day anyway.
Thank you.
And Nathan, if I could just, one other point that we did talk about earlier was sort of that certainty of clearing. When that issue kind of is flushed out, I think we'll both have to make some investments in that, and that really hasn't been kind of figured out just yet. But that's one possible hurdle.
I have a question for the CEFs again. You guys have good experience in terms of executing trades, et cetera, in the RFQ model, et cetera. What's going to be different is unwinding trades to some degree in terms of this market coming in. Can you shed some light in terms of how that process is going to work, especially for the non-standard trades, such as the interest rate swaps also? CDSs are different, wherein you can unwind the trade easily, especially from a price transparency and a price discovery perspective, and how the clearing houses are going to play a role there.
Sure, I can take a stab at that.
Please do.
Like. So I think, and sorry, was part of your question, you said you were more interested in interest rate swaps than CDS? Because
I think CDSs are easier, right? Because they're much more standard in terms of coupon dates, et cetera, right?
Yeah.
IRSs are going to be spot starting, and now if I want to unwind my trade, where am I going to get a price for it?
Definitely. Okay, so there is some talk in the market about standardizing contracts, but I think that's way away. But I think the other thing, sorry? That's right. So basically, index CDS or the snack or the snack or the stack, the way it's been done for the CDS as well, standardized and contractual dates. But that seems a way off. But some things that are already happening at a number of the clearing houses are already that if you have the same trade going in opposite directions with the same dates, then that will collapse a position, so an automatic unwind, and that helps because that means up front, from a price discovery perspective and getting sort of execution quotes, it means that a CEF can look into a clearinghouse, find your position, and we'll be able to, on Bloomberg, we'll be able to send that trade out to you in its existing form to a couple of dealers who'll be able to download that, price that, and then generate an equal and opposite trade for you. So, that kind of workflow becomes possible in this new world, or it becomes a lot easier to do. So that's certainly something that we'll look at, because I think the whole challenge with unwinds is having your initial position and being able to seamlessly go from there to getting quotes on it. Nobody wants to be able to type up the details of your original position and then shop it up for pricing.
I think that typing the trade in is the easy part. The price about, the fact about getting a fresh price on it, I think that's going to be the tougher area, because it shouldn't be like it is today, right? Like that you're beholden to the counterparty in terms of unwinding the trade, right? So the CEFs can play a big role there.
Well, that's the advantage. Perhaps I wasn't very clear in one of the things that's new in today's world is that in the old world, if you wanted to get out of a position that you had with broker A, then you could either unwind it with broker A, which was pretty easy, or if you didn't like their price, then you'd assign it to broker B. Whereas today, you will be able to trade the equal and opposite swap, albeit with historic dates, directly with broker B, and it will be a new trade with off-market dates, and that will automatically collapse the trade. So that should make things easier. So the point I didn't make very well earlier is that you'll be able to take a historic trade and shop it out to 3 or 4 dealers, and to those 3 or 4 dealers, it will be a new trade. There'll be no assignment sort of mess, but just with historic dates or with off-market dates.
Yeah, no, I think it's almost more of a question for the clearinghouses than the CEFs, in my mind at least. It's easy enough for us to do the trade, but as long as you can do an equal and opposite trade that offsets it with the clearinghouse, then all is well. I think the tougher part about that is, how your systems are going to handle it. How do you marry the original trade to the new trade and call them an unwind? Just ensure that you flatten the position for then your accounting purposes and what have you. I don't have an answer for that, but I'm sure a lot of gentlemen and ladies in the room from the Calypso side have thought very hard about that.
Unique identifiers, right?
There you go.
And another panel. Any more questions? Don't worry, if you ask a question, you're slowing everybody from going outside and having a drink. but please ask some more questions. No, seriously, any last questions? No? Good. Well, thanks to the